Hey everyone, it's PJ Patterson for a probably final market update for 2020. Today's December 23rd. Before I get into all the details we're going to cover today, I just wanted to say to everybody, it's been a great year. I'm really happy with the way things have unfolded this year, and I want to thank you for all your support from where I started with the business this year to where I am today. You're probably noticing this if you're a regular consumer of the market update stuff I'm doing. The confidence and competency level around managing the markets and their various things they throw at us has increased incredibly by myself. And the year has been a pretty good year for all of us in the sense that I've managed the monies away from danger and have managed to eke out some positive returns. And so I'm very happy about that. And I think going into next year, we're set up. The table is really set, as I've alluded to before, for a cracking first half of next year. Now, obviously, I reserve the right to change that opinion if something like the COVID resurgence and all this little stuff that's happening at the moment comes around to bite us. But I'll talk about that a little bit more in the top three things today. Before I get to those, though, please, I want to wish everyone a very Merry Christmas, Happy Holidays. Have a fantastic break. Hopefully, you'll get some time off. Please do get some time off and spend it with family and friends. I'm on the northern beaches in Sydney, so probably not really going anywhere. But I do wish you all the very best of returns this year for this year, and then I'll see you in 2021. Now, top three things today. Just to get into it, going to revisit our good friend the U.S. dollar and what's happening there. Talk a little bit about yields because the yield complex or the treasury complex is giving us some messages about what it is expecting next year. And then finally, just quickly going to touch on volatility and the episodic and non-trending spike in volatility that we've seen in the last couple of days. So to start off with the U.S. dollar, on the screen here is a U.S. dollar chart going back to the beginning of this year. And what you can see is the dollar was sort of steadily climbing as we were anticipating earlier this year. And I'll just flick over to this table here. Earlier this year, we were anticipating in the U.S. being sort of in quad three leading into the year, 2 and 3 leading into the year. And then, of course, we got whammied with the COVID and ended up in quad 4. So this chart sort of bears that out because any quad but quad 4 is a U.S. dollar weakening quad. So as we were heading into the year, we saw the dollar sort of begin to fade as the dollar index that is begin to fade from, let's see if I can get a slightly longer term chart up here, from previous levels. And it faded badly into sort of 2018. Then it ramped a little bit, but then, faded big time during the course of this year, notwithstanding that it did have a spike in the early part. So sorry to get this chart resized here. In the early part of this year when we did enter quad 4, and that was where the dollar just ramped, went, parabolic, as you can see from this chart, came back from that a little bit, but then pretty much moved sideways until approximately sort of early June when the dollar index began to signal that the worst was behind us and that we could begin looking to potentially position for a quad 3 scenario, which we did have. That was that June to sort of August period. And now, we're in that, and really June to probably September, October. And now we're continuing to see the dollar. It's really just falling off a cliff here. We're continuing to see the dollar signal that it's going to go lower and that we are definitely setting up for a quad 2 environment across the globe. And that's what this chart and that's what the dollar is telling you at the moment. So we're going to stick with that trade for the time being. Let me just grab a chart here, another chart here real quick of the dollar. Let me just see if I can, first of all, shouldn't resize your screen before moving the bubble. Let's do that. So now let me jump over to this table here. And again, this is a bit of a shorter term chart. You can see quite clearly, zoop, down we go, dollar down. Now, what was I going to show you on the dollar? That's probably about, of course, the correlation tables. That's what I was going for. It's time for a break, ladies and gentlemen. It's that time of day, and it's that time of year where PJ needs to recharge the batteries. Anyway, thanks for bearing with me. So again, here's the correlation table. Negative correlations means that when it's the upside down of the dollar. When the dollar rises, these things fall. When the dollar falls, these things rise. And if there's a positive correlation, it means they move kind of in sync with, not in sync directly, but they move very similar to the dollar. So in the case of gold, as you can see here, it's got a positive correlation over a 30 and 90-day period, which means as the dollar falls, guess what? Gold's falling as well. In the very short term, 15-day, we've had a bit of a situation where a lot of countries, Japan, the ECB, so the Europeans and the US, are unleashing these massive stimulus programs. I think in the US it's 900 billion. In Japan, it's somewhere similar, almost 1 trillion yen, somewhere in the high hundreds of billions. And in Europe, I'm not sure the exact number, but I'd say it's probably 500 or 600 billion as well. And so when those sorts of things happen, you tend to get the gold crowd getting very antsy about the devaluation of the dollar and other currencies against gold, etc. But the thing that, and I'll touch on this next, yields, the thing that we have to be very mindful of and careful about is what's happening in the global bond markets, specifically in the US Treasuries. So if I go back to my charts here, what we've seen is, again, we've seen a shift or a phase transition from a bearish Treasury market, meaning yields are falling and bond prices are rising. So the inverse of that is, you could say we've actually been having a bull market in terms of bond prices. We are now in a bear market for bonds and for fixed income. And what the yield market is telling us is they're starting to get nervous, I guess, about, oh, sorry, that's not the Treasury yield, that's gold. Where is our Treasury yield chart? Sorry, I'll find it in a moment. There we go. There's our yield chart, our yield rising. And so, this other one, just to be clear, even it's mislabeled. This says 10-year Treasury yield, but it's actually gold. So this is the gold price. It's falling as, here we go, the inverse, the upside down, yields are rising. So what yields are telling us right now, what the bond market is saying, is we're anticipating inflation. Why? Because the US dollar is falling, and that's going to spread higher commodity prices, higher goods and services prices around the world. And the bond market is saying, we understand that, and so we're going to bid up interest rates. And as such, the prices of bonds are going to fall. That's just how that works. As bond prices rise, interest rates fall. As bond prices fall, interest rates rise. That's what this signal is sending us, and it's loud and clear. We're in it now, a bull market for yield or a bear market for Treasury prices. Don't get too hung up on that. All you need to know is yields are going up. That's eventually going to impact interest rates around the world. And it is the primary reason why the gold market, and again, just ignore this headline here because that is the gold chart. This is why gold isn't getting a massive bid right at the moment. It's struggling to get above 1900 and stay there. We had a little bit of a spike in the last couple of days, again, because there's been a couple of COVID outbreaks around the world. Possibly a new strain. I think people just, they panicked and went, some people panicked and went to gold. They panicked and went to the US dollar. But again, that's going to be episodic and non-trending. In fact, I traded it, and I'm going to tell you how I did that in just a moment. So that's probably all I need to really say about US dollar and the yields. And again, I'm just going to go back to this correlation. Again, this is something I'm keying in on massively because, and here's what you really should get excited about is, I've just told you the dollar, at least at this stage, is headed lower. Look at these correlations over the longer term for the S&P 500. They are highly negatively correlated. We're going to see a ramp in the S&P, a continued ramp anyway, in the S&P, in the Russell, in all assets. Basically, quad 2, all globally is what we're aiming for. I think that's what I told you in our last market update. I'm going to show you a chart on that in a moment. But that's what we're up for, and that means commodities rising, stocks rising, property rising, currencies falling a bit. Obviously, the Aussie dollar will rise against the U.S. because the U.S. is falling. That's good for us in terms of purchasing power. But things like gold, etc., will continue to fall. So I've got positions on to deal with all of that. Now, finally, just before I get into one other chart, I just want to touch on volatility. So bring up our good old friend, the VIX, and just have a quick chat about that. So as you can see here, this is a daily chart. Look at this spike in volatility. Bam! We had a spike in vol. Now that came off the back of this resurgence of new strain of COVID, or there was some other silly announcement that came out, and everybody just panicked into that. And we had, again, this volatility. As you can see, it's been quite clearly trending down, and we're well into, well, not well into, but we're in the safe zone for investing. This is actually, if you go way back to when I first started doing these market updates, I talked about one of the volatility regimes, which is the chop bucket, meaning you're between a range and it's going between 20 and 26, 27, and that is a regime, a vol regime, where people get chopped up. They get scared because vol spikes and asset markets sell off. They react. They get excited because vol drops and asset markets rise, so then they buy. So in other words, what they're doing is they're buying high and selling low instead of buying low and selling high. So you just have to do the inverse of what I've just described. When vol spikes, you get a sell-off in markets. Buy the dip, right? That's what we have to do. Buy the damn dip. When we get the reflation because vol has backed off again, sell the rip, or you can take some positions off. And you'll notice that in your trade reports that you see, if you monitor it, that's great. If you don't worry about it. There's a couple of positions, and I am going to make the video just after this, as I said, to cover off. If you can see this on your screen, this little guy right here is all of the positions I have on currently in portfolios. I think there's 40 different positions there. That is what you call fully allocated. It's awesome. I love it. And I'm going to go through what it's all about, how we're positioned, and a bit more detail into probably not drilling down into each and every ticker symbol, because you could obviously do that if you wanted to in your own time. But I will tell you what it is and speak broadly about why it's in there and what it means. But just to lock off the volatility conversation, I'm not worried about this volatility spike because, again, it's episodic and non-trending. And I read a book earlier this year by Benoit Mandelbrot on volatility. And it was interesting, if not a little bit boring, but interesting in that it explains a lot about how the volatility affects everything. And volatility that's episodic and non-trending is not something to be worried about. It's something that you can trade. And that's exactly what I've done. And I'll go a bit more into that when I talk about how I've done that when I review these positions. So look, that's probably all I really want to say at this point for you around a market update. Sorry, there is one last thing. I've shown you this chart before. I'm just going to quickly review it again. This is the G20. And I have one of these for emerging markets somewhere. I'm not going to go find it right at the moment. But this is the G20, the top 20 economies around the world. And as you can see, right now, pretty much every single economy save Russia is in quad 1 or 2. We are in the reflation and recovery quad, and that's exactly what's been happening. Next year, we're set up in quarter 1 of 2021, globally, quad 2. Look at that. There's not anything but a 2 in sight. That is reflation. That's the inflation part of what's happening. When we look to quarter 2 of next year, again, mostly quad 2s, but then we're starting to creep in and seeing particularly China getting a little bit into that quad 3 regime. So we're just that'll bear some watching as we go through the year. But broadly speaking, still economically speaking, we're in a absolute sweet spot. As we enter the third quarter and fourth quarter, which admittedly is a long time away and a lot can happen between now and then, we're starting to see that going back into quad 3 and quad 4. And let me tell you, this is where this process, and this will be the second time kind of through for you guys in the cycle. This is where you're going to hear me change my tone and start making changes to portfolios in the second quarter of next year, probably towards the second half of the second quarter, if that makes sense. So the second quarter finishes in June, and it could be, there's a strong possibility if this plays out that I'll be starting to make positional changes and put on a quad 3 portfolio. So I'll be selling down equity, selling down all this stuff that will have absolutely killed it and ripped in quarters 1 and 2 of 2021, and look to go a bit more defensive and look, to be honest, start rebuying things like treasuries and probably buy the dollar at that point and a few other things. Anyway, we'll cross that bridge when we come to it. But this is an exceptionally powerful process, an exceptionally powerful way to look at and deal with financial markets. And I am so excited about next year and what it holds for us as investors. And I am fully anticipating, by following this regime and all of this stuff that I do, which you are becoming increasingly educated on, we're going to do very well in the first half of next year. I think I'll leave it there, guys, because I still need to do this update on the positions. And again, just want to reiterate to all of you a very, very Merry Christmas. And let's just get the bubble bigger. A very, very Merry Christmas to all of you. Again, please spend quality time with family and friends this Christmas. Every year, we all get older every year, and time is something that we all have to own up to. Eventually, we run out of it. And so if there's anything I've learned this year, it's that we do need to spend quality time with people in our circles that we care about and value, and to let them know, of course, that we care about them and value them. So please ensure that you do that this year. And again, I am so awesomely excited about next year. It's not even funny. So if you do have any questions or anything of that nature, please let me know via email. Again, the office will be closed as of today when I turn this computer off until Jan 6th. But if there's anything urgent that you need from me or whatever, obviously a couple of you, I still have some home loans and things like that cooking that need to be dealt with. But I am going to be trying myself to take a good solid break. But obviously things do happen. So if you need me, you know where to find me: mobile, email, whatever. And again, Merry Christmas, Happy New Year. See you in 2021. Bye-bye.